Hello, Baker investment students. Hope everybody is having a good weekend. I'll be on the road this weekend a little bit, traveling to see a relative in Wisconsin, so I'm just posting this a little bit early for week 5. But make sure to wrap up everything for week 4 to get your exam submitted and homework problems. And I hope to have everything graded with that by Tuesday of next week in week 5. So this week we look at, well, let's first talk about the markets a little bit. I was looking at the markets today. It's down a little bit. Obviously concerns about the coronavirus, how that will impact China. But overall, I mean, the stock market has done incredibly well lately. So it's still, we're still fairly optimistic about the future. Of course, if something were to really badly happen with the coronavirus, we hope that does not. But we've already seen that how that's impacted China and their economy because cities have just shut down. So that's going to hit them a little hard. So some other things too. I saw out there. I guess there's a new Coke. I went to the grocery store this morning and they're trying these energy drinks. I see my teenagers drink those things, and I tell them, "Hey, I do a lot of brain-based research, and the studies say that stay away from those things." So, but it's in demand. They're very good at marketing it, so we'll see if it takes off for them, if that will give a boost to Coke. So with this week, we switched to fixed income investments, or bonds, and bonds actually provide a lot of capital for corporations, and it's a major component to a lot of portfolios too, even mutual funds. There's different types of mutual funds. I think I have one through my retirement at Fidelity. Actually, I have 3 different ones. I think one's a corporate bond fund, one's an investment grade fund, and there's another one I don't remember the exact name of. But obviously with bond funds, with a fixed income investment, you're lending money to a corporation or the government, and they're setting a coupon rate. For the most part, it is fixed. Some instruments are variable. And that rate will pay you, based on that rate, they say if it's at 10%, they'll take that 10%, they'll divide it by 2, and they'll pay 5% every 6 months. So some of the examples in the textbook, they'll show you it's annual, but I'll tell you that most bonds pay semi-annual. So if you had a 20-year period, it's 40 payments you receive over that time period. But the important thing we have to remember about bonds, it's an inverse relationship. So if you bought a bond originally, it was $1,000 and it matures in 10 years and it has a coupon rate of 8%, well, perhaps interest rates may go down. And if interest rates go down, the inverse relationship says this: when interest rates go down, the present value of that bond goes up. In Excel, we use PV, and we use rate for yield to maturity. But it can be the opposite. If rates go way up, the price of your bond is going to go down, because investors are going to say, well, why do I want to buy your bond when I can go out to the market and buy a other bond that pays a better rate? So what you have to do as the investor, you take a capital loss, you have to sell it at a lower price, so it gives that individual the same return. So with bonds, we have earned interest, and we also hopefully get a capital gain. Bonds are priced mark to market, so it's as if you had to sell that bond today. So that's, so if you do have bond mutual funds, if you own a bond, they're going to adjust the price of that mutual fund based on whatever the current demand is for those bonds, or rates, or yields, and they'll adjust those prices. So bond prices do move, and there are some professional bond portfolio managers that are very good at trying to foresee interest rates, which way the rates are changing. That's why so many people pay attention to the Federal Reserve, what they're going to do, how that's going to impact rates, because if I can predict that, then I can know which bonds to buy and how to make capital gains on those bonds. So, all right, some of the things I want to make sure to cover this week with these, talk about the different types of risks with bonds, interest rate risks. Obviously, with bonds, you're making this assumption that you reinvest at the same rate. We'll talk about that later with duration. But the purchasing power, yes, I get this cash flow in the future, but what is that worth? The business financial risk, what if Coke, all of a sudden Oprah said, stop drinking Coke, even energy drinks, that's probably going to hit that company hard. It's a business risk, but also companies leverage themselves sometimes with too much debt, and are they going to be able to pay that bond back? There's also, the idea of like a call or prepayment. So, depending on the agreements of the bond when it's written, They may, if interest rates are more favorable, call that bond back to refinance it. So in most bonds, they have to set up what are called sinking funds, to set aside funds to make sure that, if you had this $50 million obligation in the future, that, hey, where am I going to come up with $50 million if I'm a company? Well, you put money away slowly over time to make sure you have that available, or you're going to have to refinance some additional debt and have that prepared ahead of time. There are some benefits of doing we call municipal, or those that have tax advantages. You have to make a decision: do I want to take a bond that's taxable or one that is not taxable but pays a lower rate? There's something called like a taxable equivalent yield. Basically, you're taking that stated coupon rate divided by 1 minus the tax rate, and saying, hey, I may be better off with the one that is not taxed. Some different types of bonds I'll mention too: the mortgage-backed securities, Freddie Mae, Freddie Mac, a lot of the agencies. I know the veterans, I think they have one for the mortgages. So, and with these, they also discuss collateralized mortgage obligations. So when you get a bond, typically with that, or let's say a mortgage, that mortgage is sold off to some other institution. They package all these mortgages together, and depending on your behavior, how you pay off on that bond, they will put you in a tranche. And when I was at the credit union, I used to be a trader there, we would buy a lot of these mortgage-backed securities. In fact, that's what got U.S. Central Credit Union in trouble, is because all their collateral, a lot of it was backed up in these mortgages. And when the subprime crisis hit, they said, hey, your collateral that you have in capital to back up your assets, well, these things are not, they're kind of worthless now. So they got in a lot of trouble, and a lot of other financial institutions got in trouble too. That was because these companies that wrote these credit default swaps, which promised that, hey, don't worry about it, your bonds will always be okay, the mortgage-backed securities, collateral mortgage obligations, because we will insure them. And they made a lot of money writing these insurance contracts, but when things did change and home prices went down, AIG and these other companies had no way to pay these off, so they were gambling, and that's why there was a lot more regulation that was put in place after that. So with that, one other thing I want you to check out too, I think you'll find it interesting, is I put out there in the Treasury yield curve, and you'll see this yield curve change over a period of time. Some investors like to watch this because it might be a harbinger of things to come with the stock market, the economy, and interest rates. Sometimes you'll see a normal yield curve, it's upwards. Other times it could be inverted, where people are buying a lot of long-term bonds. So what they're doing is they're pushing up the price, and then the interest rates go down. But there's some theory associated with that shape of the yield curve. One is just like liquidity. The textbook mentions that if I had a CD that was 1 year versus a CD that's 5 years, you would expect to have a higher rate of return in the 5 year because you're taking a longer period of time. I would say there's also what I call the market segmentation. This relates to more supply and demand. There's people that want to lend short term and borrow short term. There's people that want to lend long term and borrow long term. So it's really supply and demand curves shifting, determine the interest rate in that market. And the last one, future expectations, is, should I buy a 1 year treasury or a 2 year treasury? Or I said, let's do it this way: 2 year treasury or 2 1 year treasuries. Well, uh, based on what the interest rates are right now, that should be already priced in, and you'd be able to kind of understand what the future expectations are for interest rates. So wrap this up with the last chapter, and I put some examples out there in Excel in week 5 for you. I know there's that chapter 11 table already that I put there earlier, but I guess give a little bit more explanation. So I think it's good to go in there and just click on that cell where the answer is, and if you go to the FX function up top and click on that, it's kind of right below the dashboard. It's kind of like a little math symbol, looks like FX. That will pop up that functions argument box, and you can see a little bit better about how I arrived at those answers. But one of the things that I want for you, I think that's a good benefit of this course, it just keeps reinforcing the quantitative aspects of your learning, is really, building this brick wall, if you will, of understanding, how does this stuff work? Why would it matter, if the price of the bond change? It's helping clicking through your mind, seeing, as these cash flows are staying constant and interest rates changing, this is what investors should pay for this bond, or this is what is happening to my rate of return. So you're going to go through things like The present value, that's the price of the bond. One thing I always tell you in these textbooks, they always use like the future value is always $1,000, that par value. The coupon rate is really just saying $1,000. If you had a coupon rate times 8%, 1,000 times 0.08, $80 every year. But semi-annual, we really need to take that $80 divided by 2. So that's $40 every 6 months. And if it was a 10-year bond, then we got to double that times 2. So that's 20 periods that would be getting this payment over and over again for the next time period. And the rate function Excel is used to like yield maturity. Again, this is the rate of return that you are getting, but interest rates can change in the market, and that's where you put that function, in the when you're looking at, like a present value, you put rate in. And if you're looking at yield maturity, you're kind of looking at, hey, how much did I pay? What do I get in the future? What is my coupon payments? So walk through those examples in Excel. Now, I think it'll help you understand those a little bit better and help you with the homework. But I think to wrap that up, again, if you have any questions, do send me an email. I'm happy with the performance of the class. Especially on the papers, I thought you did a good job on those. Start thinking about that journal article for the next one. Kind of just some minor things with MLA. Most people, I think everybody did MLA, but if you do that, go to that Purdue OWL website and look at that sample paper, because that's what's expected in academia, especially like these journal articles that you read. They were required to have that to the T. So we want you to build up that skill set, especially if you go on to do other graduate work. So otherwise, let's hope those Chiefs can win this weekend. Have a great weekend, and I will talk to you online.